I'm a one-trick pony on marketing, and this just happens to be like the one trick that happens to be really, really good for this audience, which is just kind of relentless, radical transparency about everything that we're doing.
Peter Saddington, your big game hunter. And guys, we have our sights on someone special today.
Only a mother could invest in this idea.
Made this like super artistic.
That is actually absolutely correct. And that's a very, very astute assessment, actually.
True startup story, guys. You got it. Your company just got seed round financed. Congratulations. You're going to the moon. But now you have to scale. You found great talent out in California, New York, Georgia, and even Eastern Europe. So what communications platform will you be using to ensure your international team is always aligned? Well, the answer is easy. Slack.com for Teams. We've used Slack for all of our previous startups, and they've supported us in tremendous ways. And we want to give them a thanks today for supporting vchunting.com. Did you also know that Slack is a great tool for personal use? Yeah, I use my own personal Slack channel to drop in documents, notes, to-dos, and follow-ups to ensure that my workflow throughout the day is right on course. I promise you, if you try out slack.com for personal use, you'll end up using it for your team as well. Go to slack.com to check it out. Welcome everybody to another episode of VC Hunting, where you guys know we find some of the most interesting VCs out there and their intriguing stories. We have a great guest today. It's Tyler Tringas, who is the GP and founder of Earnest Capital. Tyler, thanks so much for being part of the show.
Yeah, thanks for having me, Peter.
Well, let's just jump right in. Give us a little bit of history. What got you into venture capital and what's keeping you here?
Sure. It's a funny question because to some extent, I don't know if I consider myself in venture capital per se. Our sort of vanity URL is not.vc. Yeah, we're not.vc. If you go there, you'll end up at our website. But I think that's mostly just because we do so many things differently. But
yes, we're going to talk about that.
Yeah, but how did I get here? I guess investing in founders. I think it's one of those things where to some extent you're just sort of find a thread and start pulling it. But then as I sort of look back on my career, it also is one of those things that kind of just makes sense. So I'll give you the quick overview, which is, I started my career actually in sort of finance. So I didn't have a background in computer science. I was never really in tech startups, let's say in college. And afterwards I joined a startup, but it wasn't a technology startup. It was a kind of a research and consulting startup focused on the clean energy market. So we were advising like project financiers and pension funds and investors, but also operators just in the solar, wind, and all that sort of space. And got acquired by Bloomberg. And I worked, ran an energy economics group at Bloomberg for a little while, but it was all, totally outside of software and tech, with the exception of some manufacturing stuff. This is kind of like totally disjointed, but it comes into play a bit later on. So I quit my job there and decided I wanted about a decade ago now, actually 2010, and decided I wanted to start a software startup, mostly because of a market opportunity. So I sort of really understood the solar market, and we basically built one of the first ways to get a really, really fast quote for your home. So this exists all over the place now. It was one of the first, maybe the first, hard to say, but where you go on Google Maps and you draw your roof and you get like an instant, we figure out how many panels can fit on there and what your utility provider is and all that. And we say, makes sense, you should switch to solar, you'd save $50 a month, here's how you can here's how you can take the next steps. Fundamentally like a lead gen business. But I started this company, and because I didn't have any real background in tech, I sort of put together this business plan that had a really strong chance of a good outcome, of a 25, 50 million, maybe $100 million outcome. I never even considered the idea that what if this became $1 billion company? I was like, I have good roadmap for building a great company. So I'm sitting there with this idea. We have this kind of proof of concept. It's sort of working. And I say, okay, I need a little bit more capital than I have. And there's code involved here. So I guess I should be raising venture capital, right?
Right.
I think people are a little more sophisticated now, but this was not crazy, in 2010, I think. The Lean Startup had like just been published. People were just starting to figure this stuff out. Exactly. So that what followed essentially was a 3-year period of basically a deep, deep understanding of the Venn diagram of good business plan and business plan that is a fit for venture capital. And we were not there.
So you're telling me you learned something.
Yes, we learned something. I mean, essentially the long story short is, the business ended up failing. We raised a small angel round and then just, pitched about 400 plus investors, including basically everyone that that's still in VC today. And essentially, discovered through that process that, hey, this is just not a fit for the venture risk return profile. It was a good business plan. Everything in our 2009 pitch deck, like most of it happened, we were pretty much right. But the business failed because we were looking to get misaligned capital, essentially. So
I also think I remember reading that you wrote about that. The timing also was rough as well. Is that correct?
Yes. I mean, it was challenging. You never know why you don't raise money, right? It's very hard to draw causality. But one of them was there was this huge, surge of investment in clean tech writ large in the venture community. A lot of it was led by like John Doerr at Kleiner. A lot of these legends were pouring like huge amounts of money, hundreds of millions, billions of dollars into green tech writ large. And then they lost their shirts.
Absolutely. Even the government lost its shirts on it.
Sure. Although caveat, the program, so Solyndra was a very high profile failure, but the actual loan guarantee program was a huge success on net. But that's neither here nor there. The venture exploits into clean tech during that period were a giant failure. They put huge amounts of money into, for example, in solar, trying to build really new innovative types of solar panels. And it turns out what you need to do is take the existing kind of, models of solar panels, move them to China and scale them up massively and have a version of Moore's Law come into play. And that was way, way cheaper than anything that you could design that was new. And so people had, they had put in $300 million into proof of concept, plant one.
I remember the TechCrunch articles. TechCrunch was all about it.
It was horrible. And so we were part of a little group of people that were trying to rebrand this as Clean Web. We were like, look, we're still solving the same problems. We still have all the underlying, momentum around climate change and carbon pricing and all that, but it's capital efficient software, right? Did not fly at all. I mean, a lot of investors were just, gave us very sophisticated answers, but a huge number of them were like, look, we're not investing in clean tech right now. Sorry, the end. Like there's no momentum around it. We don't know if you'll be able to find co-investors. We don't know if you'll have follow-on investors waiting for you for the subsequent rounds. There's a rationale to that kind of herd investing.
In today's climate, it might actually work, especially if you call it clean web and you also give the public your procedure for ensuring that you have zero carbon footprint. Like the political landscape today, I mean, maybe it's time to resurrect the idea.
It's a fair point. I mean, that is a very, very recent development. I think we're hearing a lot of announcements. To be fair, I haven't seen a huge number of deployed dollars into clean tech in this most recent wave. But I'm very optimistic and I'm very happy to see it. And, I hope somebody picks up that business plan and runs with it. And, I'd be happy to participate in funding it, to be honest. It's still a good idea.
Capital call. Sounds good. Well, so tell it, what brings you to here? Because I did, and I'm going to be just transparent here. I mean, I read your means to an end, October 3rd, 2017, selling my bootstrap SaaS business. I would say it's a blog post, but it's not. It's more like a treatise on, like the grand soliloquy of your life about StoreMapper. And so give us a little bit of context about the lessons of StoreMapper. Obviously, we can't read 16,000 words, guys. And where does that bring you to today?
Yeah. So the last piece of the puzzle is, I'm working in finance. I pivot to clean tech. I learned a ton about what is and is not a venture backable company. I basically effectively went broke. This was a pretty tough time.
I remember reading.
Yeah. I peaked out about $60,000 in credit card debt, which was how it was essentially, that was my friends and family round for the next business. And essentially just pivoted completely hard. I said, look, I don't want to be dependent on fundraising. I've been doing that for 3 years. I'm going to, at that point I've been teaching myself to code, kind of was floating myself by essentially, freelancing as a Rails developer on the side. And was looking for ideas that were, very niche, very easy to deploy super quickly, and had just essentially very clear recurring revenue business models, and tried a couple of them and eventually hit on this very simple niche idea that, is like, it's, when I would explain to people later, is like they couldn't even believe that it could support one person. But it was essentially a micro SaaS, which is the kind of term that I coined for it later. A B2B SaaS business that solves a very particular problem for a very wide subset of specifically e-commerce businesses in this case. The actual business was a store locator as a service. You had this huge number of brands that, they needed to tell you, hey, we did our Kickstarter. Now we're in, all the Whole Foods in the Northeast, or we're in these various boutique shops. Here's where you can buy our stuff, and nobody knows that. Google doesn't know that, you can't search for products, at that level. Right. So they need these store locators. We first built it as a little widget, and then we started layering on top of it a bunch of services and stuff. So it turns out there's really cool analytics off the back of that. Hey, 1,000 people searched, where can I buy your product in Portland, Oregon this month? And your answer is nowhere. So you should maybe get a store there. But it was essentially just something I built the whole thing myself. I launched the first version, got to paying customers in like 48 hours from starting the idea to, some money in the bank. The summary of that is I ran the business remotely for about 5 years, and built it to a small team, learned along the way the power of these bootstrap SaaS businesses that you don't raise too much capital, you get them to a certain point, and they're effectively just ATMs. They just throw off more and more cash with you have enough of a team to just cover it, and they just every incremental dollar goes into your pocket. Right. And then I sold it to a private equity shop called Sureswift Capital about 3 years ago, which basically brings us up to today and the next thing, which was Earnest funding those companies.
So before we move into Earnest, I'm sure, because we got an internationally syndicated podcast here, I'm sure there's at least one person that's thinking right now out there listening to you, Tyler, and saying, he just gave me a really good case to not sell that business. So what was the reason? And obviously, guys, everyone out there, you can go read the blog post. We're going to put the links in. But tell us why. Give us a good reason or rationale, because if it's an ATM, cash cow, come on, baby. Tyler, you're not speaking rationally here to the vast majority of maybe some of our listeners.
No, that's a very fair point. I mean, and I think there isn't an obvious answer in the sense that I say this in the blog post that I wrote about why I decided to sell, which is that if you just are analyzing it from sort of a spreadsheet math perspective with a profitable recurring revenue, SaaS business or something like that that has high margins, that essentially grows organically, you'll never build the case for yourself to sell it. You can always wait 6 months, right, get a little bit more profit in your pocket and grow your MRR a little bit and sell it for slightly more off the same multiple, which is totally fair. The reality is most people sell the business for other reasons, which are exogenous to that spreadsheet, right? And so in my case, it was, I remember reading this, there's a story that's kind of like the inside story of Twitter. I can't remember which one it is because there's been a couple of them, but there's one little anecdote where I forget who is who. I think it's Biz turns to Ev when they're still working on the podcasting thing. And he goes, if we do this, we'll be the kings of podcasting. And at that time, podcasting was, not nearly as important. And they go, do we want to be the kings of podcasting? And they both are like, no, we don't want to be the kings of podcasting. So, I mean, maybe that was a mistake because podcasting is, kind of taken off. But for me, I had the same moment, which was sort of like, hey, do I want to be the king of this really small niche market, or do I want to level up and try something harder essentially? And that was the impetus for me to sell, which was essentially, okay, if I can sell this business and get a big chunk of money right now, that enables certain things. I didn't 100% know that it would be starting a fund. But that turned out to be one of the things that, it's very hard to do, even with a nice, healthy kind of passive income, to be able to front the capital that you need to launch a fund. There are other things you can do. You can get into nonprofits, you can do all kinds of stuff, but there are certain things that are possible once you do that, and that's one of the main reasons that I think a lot of people do that. The other thing is diversification. Also, right. I was terrified. It was like I had this check coming in, but I wasn't diversified at all. And it was always this question of like, hey, does Google tomorrow just decide, hey, what you're doing is against our terms of service, and you need to shut down?
Fair enough. Absolutely.
So
the crypto head would say Bitcoin as a store of value is how you should diversify.
Did you know that there's even more value than just audio or video? Follow us on Twitter, Instagram, TikTok at VC Hunting, and make sure to sign up for the VC Hunting newsletter, where you'll be able to get weekly news on venture capital, startups, founder stories, and the occasional wisdom extracted from Peter's brain. Go to vchunting.com to sign up. And now back to the episode.
But you've caught us up to today, to creating venture earnest capital. I'm sure you're going to tell us a little bit about the formation of it. But what I really loved and enjoyed through my research on this and on you is it really is focused. I mean, there's a tagline there: funding for bootstrappers, right? And I think you've given us a little bit of a preface there in terms of, hey, you went through the entire bootstrapping experience with your own company. Obviously, the ups and downs, high lows, emotional moments. I think I'm projecting my own insecurities here. Times I want to kill myself.
I think so.
Those
are universal.
I know, seriously.
Universal among founders, yeah.
Right. I bootstrapped myself. I know exactly. And so you have obviously an affinity and a deep love, and more than that, you have a deep appreciation for us, for that grind and that hustle. So talk to us. Give us a little bit of the context of how Earnest Capital is formed, and why is it that your thesis is so laser focused on the bootstrap economy?
Yeah, I mean, it mostly just comes out of my personal experience, my direct personal experience, and then having that amplified across conversations with other bootstrappers. So pretty early on in the process of building that company, I was really inspired by folks like the folks at Buffer and others who are sort of practicing this radical transparency around building companies. And I thought, this is cool. I enjoy doing this. I feel like it allows me to pontificate about business stuff with the appropriate context. You can say, hey, like, this is my thought, and then you can go look and see, oh, this is a guy who runs a 10K MRR business. So like, he knows about that, but he doesn't know about, running a, 20 million ARR business. And so, but the process of writing those blog posts really gave me access to a bunch of other founders who were either currently doing the same, were way ahead of me, or aspired to do the same, and then subsequently did. And so I kind of built this network of these bootstrap founders. And when I started asking them about, at first just an ad hoc conversation, and then later in a focused way about, hey, tell me about, what it took to get this off the ground. Tell me about the early stages. Right? And you pretty much exclusively hear horror stories, right? It's like, it's very, very hard to bootstrap a business. And even though these businesses, once they get the engine running and you have your minimum viable team in place and you have enough recurring revenue, they're incredible businesses. But to get them started, it's just a nightmare, in the sense of like, just the sheer capital constraint. Every single person is like, same as me, massive amounts of credit card debt. I had to move back in with my parents, and once or twice they had to write a check to make payroll, because we were just literally not going to make payroll for 1 week, all this crazy stuff. And it's like, and then you contrast it with, what happens in Silicon Valley and in the venture world. And it's like, these people have ideas and all those problems just get taken care of for them. And so you can just see the demand just at the earliest phases, just enough capital to not have to build the entire business up during nights and weekends, right? Just enough to be able to hire your first customer service person. Right. And so there's just huge demand. And I kept talking to people saying, what did you do? And I didn't hear a single good, consistent answer ever. And so we thought, okay, there's clearly demand for this. Everybody says this is a huge problem. We don't know how to solve it. Everybody would like to do something like this. And this is why I started the, like, how did you get here, all the way back to the working in finance, because I go to these meetups and I meet these bootstrap founders. And what I often find is, they're much better than me at so many aspects. They're incredible at email marketing, incredible content copywriters, et cetera. But I'm like the one weirdo who's actually like, yeah, I can fire up a financial model and I can like model your whole business from scratch. No problem. That's like, I was an absolute spreadsheet jockey for 5 years. And so I thought, well, I don't know, maybe I can solve this, right? Maybe we can build, the sort of financing product that can bridge the gap between this really pent up demand at the early stages of these bootstrap businesses to these incredibly powerful economic assets that I'm also familiar with among the sort of successful bootstrap founders, and that was basically the thread that I just started pulling.
One of the things that I really appreciated about your story is how you leverage community, and I truly believe this, having spoken to hundreds of VCs, not just the ones that you guys see here, is that community is often something that a venture capitalist lacks when they come into the game of venture capital, and so they don't have an existing network of supporters and or subscribers and or fans, fill in the permutation of your choice, that they can leverage and really engage with to understand the boots on the ground issues, the real problems that need to be solved. And so this is a really unique perspective, and I appreciate that as a community builder myself. Talk to us a little bit about this community that you ended up growing, nurturing, and then leveraging. Tell us a little bit about that story. I think it's going to be great.
Yeah, I mean, I would say that I break it up into two pieces. One is just the sort of public, community in terms of the audience and people that engage with us.
Right.
And there's also some interesting stuff around the remote mentorship community. So I'll put a pin in that for later. But So Earnest, I think, has been very fortunate to build up a pretty significant community audience, very engaged group of folks. And I think that comes out of two things. I mean, the first one is it was by necessity. We had a pretty unique challenge when launching Earnest, which is that we were launching to a self-identified group of folks that were highly skeptical of the idea of investment, period, right? They literally call themselves bootstrappers, right? They almost define themselves in their business by the idea of not taking outside capital, right?
Can I just cut in? Have you found that because they've identified that way, that it creates a dogmatism to their mental models around how they should operate, which then precludes them from even the optionality of taking venture? Is that fair?
Yeah, I don't know if I want to say dogmatism, although I'm sure it's applicable to a small minority of people. I mean, I would just say it's a default skepticism of all forms of capital. And so one of the things that we wanted to do, right, which is to go in and sort of cleave apart this idea of like bootstrapper, I think contains this stack of definitions. And a lot of it is stuff that we wholeheartedly agree with around, building sort of, calm companies and building, maximizing sustainability, maybe even sometimes at the expense of short-term growth, making sure that you build like remote distributed teams and you're not hiring too aggressively and all this sort of stuff. And also stacked in there was this idea of never took any outside capital. And we were trying to see if we could sort of cleave apart that little aspect to say, you can do all of this other stuff that's kind of bootstrappers, and you can also have some capital at the early stage when you really need it, hence funding for bootstrappers. But we knew we were going to go into quite a bit of skepticism, and the only strategy that I knew that could counter that was basically radical transparency, right? So it needed to be as open source and inspectable as possible, in the same way that you feel comfortable using stuff like SSL, because most of it is open source, and so you can collaboratively inspect, and anyone can point out a flaw or something, or to use the analogy, if there was something sketchy we were doing or some hidden term or something like that, if we just gratuitously overshare every single thing we're doing, then the incremental founder who hears about us can say, well, I don't know, I mean, this is so public and out there, and I can see the Hacker News comments and the Indie Hackers threads and all sort of stuff. If something was truly fishy here, if this was really just somebody trying to bait and switch me or something, somebody would have found this.
Exactly. Where's the $9.99 monthly subscription?
Right.
It's not here. So what system did you use of record? Did you use Git?
Well, no, we basically just published it all on our blog, which is just a WordPress site. But it was just more of a, like just to start, you can go back and you can look through our blog. The first blog post we wrote was just like, basically, hey, help us design funding for bootstrappers. This was, we had started raising the fund. Yeah, we started raising the fund. We hadn't launched yet, and we were very clear. We're like, look, we're not investing right now. We have a draft of a term sheet of a structure that we want to use. Here's our strategy. Here's our blah, blah, blah. We put the Google Doc up there with comments open. Public link, anybody can drop a comment. And we got like hundreds of comments from people just saying, what does this term mean? And could this be here? And how does this compare to, the
awesome.
YC documents and all this sort of stuff? And that was, I think, necessary as a strategy, right? To just convince people that, hey, we're doing this in good faith. This actually is funding for people like you. But it also built a great community, right? Because this also happens to be really interesting content for people. They like to see the inner workings of this sort of stuff. I think it's why, for example, like Fred Wilson's blog is so popular, right?
Exactly.
I mean, the writing is, it's good, but it is not Hemingway, right? But it is
short and sweet. It's short and sweet, often.
Right. But it's the fact of getting this visibility into the minds of people where the decision-making process is so critical that if you are, so the other piece is like, I'm a one-trick pony on marketing, and this just happens to be like the one trick that happens to be really, really good for this audience, which is just kind of relentless, radical transparency about everything that we're doing. So that's been the main way that we've been able to get this community, engaged and excited about it. And, it pays dividends. Basically all of our deal flow is 100% inbound from just folks who've read something we've written, and then they, recommend somebody else who says, hey, I don't think we're fit for VC. We'd like to raise, you should talk to Ernest. Yeah. So
I love it. And I love it because I don't think many people realize that there are new permutations of venture fund out there, and there still is yet to be horizons that can be expanded, new ways of injecting capital into startups. Obviously, a big thing in the recent news was indie VC, these types of things. Obviously, And so what's really, really cool, and I think really encouraging, is that you're showing us and telling us and proving to us that there's a model for Bootstrappers that is effectively working. And what I love the most, and you've said it many times, is the hashtag radical transparency. I use that. I created a 50 plus video series where it was all hashtag radical transparency about how I dealt with depression as a founder, right? These types of things. And that really, to your point before, that's how you build a real, true, close-knit community. Is that fair?
Oh yeah, totally. I love that. And I think that's, you touch on something important, which is, there are always levels of radical transparency to be explored further, right? And,
For sure.
We were talking about this before we started recording, but I was talking about how launching this fund has been like really hard, and like radical transparency. I have adopted radical transparency in terms of our business processes and our strategy and blah, blah, blah. But, there's still room to push further in terms of, what does it actually take to do this sort of stuff, as a founder and as a founder of a fund or a founder of a company or whatever. There's more to share, I guess.
Absolutely. So let's get into a really unique aspect that I'm sure many of our listeners and watchers don't know about. And certainly this was new to me as I was going through it. I had to read through the entire daggone document to fully understand it. And it's really cool. So let's talk about this shared earnings agreement structure, or SEAL for short. How does this work? I think I have a pretty good understanding now that I've read through it, but give us the skinny. How does this new type of venture funding model work? And why is it successful in the way that you deploy it?
Yeah, I mean, so basically one of our first problems when trying to design Ernest in terms of the funding for Bootstrappers was we had a good sense of the kinds of companies that we wanted to back, and we also had a good sense of what success for them might look like. And oftentimes, if you work backwards from, hey, I want to build the next Basecamp or Wildbit or Gumroad or something like that, you think, okay, well, if I had given you, an investment on a convertible note or a safe, you would have a great outcome, but it would not be great for me as an investor. You never raise another round. I haven't converted, and your business is just very profitable, throwing off dividends. So the first thing we had to do was to look at the sort of quiver of investment vehicles and say, well, there's not really one that actually aligns our interests here. And so what we did was just work backwards, essentially from first principles, say, okay, what, in every kind of one of these outcomes from these kinds of companies with these strategies and tackling these markets and all this sort of stuff, how can we make sure that we when it's a success for the founder, it's a success for us, because one of our other kind of constraints was we didn't want to have any control. So we never take a board seat. We really, frankly, don't ever even own significant equity in the business. It normally is only like convertible basis as you right before you sell, or if you raise another round. So we have no control. So we have to have incentive alignment. And the main thing there was what happens if you build an ongoing, sustainable, profitable business, which was the default goal of the companies that we're trying to back. So we need to make sure that that was a success for us too. We designed the shared earnings agreement. It has a couple of nuances to it, but the meat of it is essentially, you can think of it as a safe. So it's got all the convertible elements of if you raise follow-on financing or you sell the company, you can just compute what percentage of the business we would get in those events. The other piece is, if the business generates significant amounts of what we call founder earnings, which is a combination of the founder's compensation and profits, because that's one of the problems is you have these profitable businesses like, oh, well, the founder paid himself $1 million salary and there's no dividends. Sorry, preferred investors, you don't get any. So we just lump those together. See, anytime you're generating any significant amounts above a certain threshold, we're entitled to a percentage of that as well. And then those two pieces essentially interact. So the more that you repay to us via shared earnings, the lower the sort of implied percentage in the event of a sale or a conversion is. There is a cap, yeah. So the shared earnings have a lifetime cap, which is a multiple of our initial investment. And then once you repay that, you don't have to pay any more shared earnings, and the percentage is reduced. This sort of implied equity percentage is reduced, but it doesn't go down to zero. So we still have this kind of long-term perspective that, hey, we want you to keep building the value of the company, even though you're not paying us shared earnings. I will say a lot of people have questions about this idea of the cap. And I will say, first of all, it's not. So one thing to clarify for prospective co-investors and people who want to launch a fund in our space, which I'm highly encouraging of, it is not a cap on total returns, because of the fact there's a residual piece. If the business is ever sold later, if you back the next Atlassian, you're going to get, your early return via shared earnings. And then when they IPO, you'll still get a massive multiple. The second piece is it's not a mandatory part of the idea of shared earnings. We have actually even done one deal which was uncapped. It was just a perpetual percentage. The only reason for the cap is that what we discovered with founders is that particularly these kinds of bootstrapper founders, they are very sensitive to the idea of the total quantity of money they're going to be paying to you over time in exchange for your investment. They're very concerned about the idea that, hey, if I raise $200K from you now and I build the next base camp, I don't want to be writing you like a $2 million dividend check in year 13 from now. Right?
Exactly.
You say, okay, you're sensitive to that. I'm sensitive to IRR, because right now I've got basically infinite reinvestment opportunities. I've got way more deals than we can handle. So cool. Let's see if we can make something that looks good better for us on an IRR basis, and is better for you, because at a certain point there's a cap. And so essentially that's all the cap does. It allows us to basically ask for a larger percentage than we otherwise would. So just to give totally made up numbers, you might think 8% perpetual profit share makes sense as a founder. We might say, okay, cool. We want like 18 or 20, right? But it's capped lifetime. So you look at the cash flows, instead of being really, really backloaded, and the business is successful, it's pulled forward. We get more in the earlier years, and then there's a cap. And when you run the math on that, it ends up being about the same or even a little bit better on an IRR basis for the fund. And the founders are happy. So,
and I want to make sure that we set the context, because a lot of our viewers or listeners might be saying, well, it sounds like these guys are there's no exit opportunity. That's the context. These are bootstrappers. Their model, their mental model, their worldview this is in many cases, and I can speak from experience here, in many cases, the desire is to have recurring revenue. That's it. There was no ever, hey, let's change the world. Let's make the next Uber. It's how can I supply for my family efficiently, effectively? If it continues to grow, great. I need some venture capital here, but I'm not going to be selling this business because this is going to become a family business. So this is the context in which we engage with these individuals. And so secondly, I really love this model because from just the way that you communicated it to me, it tells me that there's more skin in the game on the investor side. It requires much more conversation. I mean, when you take, I'm just going to make this easy. You take the three basic models of venture capital, they're all known. if you say X, that's what's going to happen. You say Y, it's going to happen. You say Z, this is how the deal's going to go down. But with Bootstrappers, it requires so much more hands at the table, face to face. What is this deal going to look like? And it really, that this type of conversation is something that should be happening at any type of venture deal opportunity. But with Bootstrappers, it certainly is more important to them. Is that fair?
Yeah, I think that's fair. One of the things I will say, though, that, you kind of briefly mentioned that the Bootstrappers don't ever want to exit. I would say that, there's that is, I would say, disproportionately true. But relative to, let's say, folks who are, running up and down, Silicon Valley trying to raise venture, they clearly understand that they're getting into this with the idea of an exit. But I think the market is changing quite a bit on that. Essentially what has happened at the very high level is that a couple of big private equity funds like Vista Equity and Constellation have essentially proven that these bootstrapped, profitable SaaS businesses are unbelievable economic assets that, once they reach a certain scale, they essentially throw off profits forever. Robert Smith, the founder of Vista Equity, has this incredible thing where he talks about how essentially companies will still, even if they're on the verge of going bankrupt, they will still pay their SaaS bills because their whole business cannot run without these critical SaaS components. Right. And so the consensus is that these are amazing assets to own. And, much like I kind of went through the process and decided to sell my business, there's just humongous amounts of demand building up on the buy side to say, hey, this is not the private equity, we're going to buy it, we're going to gut it, we're going to fire everybody and extract every profit. It's like, no, we're going to buy this business from you. We're going to keep the entire team. We're going to run it forever. We're not going to change anything. All we want to do is just make sure that this keeps throwing off profits for a time horizon, which is well beyond your personal time horizon. We want to keep this going to year 17. Can you, founder, right now commit to running this business for another 17 years? No, probably not. I don't know, and so there's just a huge amount of demand for these businesses. So, while we don't ever do anything to force, we literally have no capability to force the founders that we back to sell, and we structure it to where we will get a good return, just via the shared earnings piece. I do believe that a number of folks are going to increasingly be looking at, truly life-changing amounts of money and decide to sell, which is, certainly a part of our fund's model, is that some of these will be sold, not in a sort of strategic acquisition where Google buys you, but just in terms of investors come and offer you a very attractive multiple on your current profits and you decide to sell.
That I appreciate that vantage point, and I appreciate that perspective. That's not something that I assumed or knew. I didn't know that there was a growing demand and a growing market for these bootstrap SaaS business models of sorts. So that's really cool. I would now that I've heard that from you, and I'm kind of connecting the dots a little, it does make relative sense in terms of the rise of the remote economy, the rise of the single individual online building stuff. And so it does make sense that over time there would be better tooling for those tasks, better tooling for administratively of that. And so that it really can allow for the growth of the 1-man or 2-person show that is a bootstrap a business. So that makes a lot of sense.
Yeah, I call this, so I wrote this, we're going to reference a number of multiple tens of thousands of word pieces here. So everyone's going to have a big reading list afterwards. But I wrote, I published our thesis, sort of our long-term thesis recently this year in January. And one of the things I flag in there, and I don't know, I think I might not have invented this, but I can't credit it anywhere, is the peace dividend of the SaaS wars, right? The idea that we had a huge amount of venture capital went into funding, all the likes of Salesforce and Shopify and all this sort of stuff. And what that means is that when you go now to start a SaaS business versus 5 years ago, 10 years ago, 15 years ago, you have just an unbelievable amount of tools, whether it's incredibly well developed and contribute to frameworks like Ruby on Rails or Laravel, stuff like that, to the fact that for every piece of a SaaS business, you've got something. You've got a help desk. You've got, a SaaS for README docs. You've got a SaaS for following up when people's credit cards expire. All that stuff is built. You don't have to roll any of that. Absolutely. And so when you come and you say, hey, I deeply, deeply understand this incredibly narrow industry, I want to build SaaS for the logging industry, right? And and you're like, well, if you had to, raise $50 million to be able to ship a V1, okay, does it make sense? But if you can basically bootstrap that or build it with, less than $1 million in capital, you can build a real business and generate real returns for folks. And it's because of this PS dividend that has made it so much easier. It's still hard, right? But it's comparatively much easier and less resource intensive to build a SaaS business.
And it's only going to get easier with the rise of no code and GUIs and WYSIWYGs that allow the average normie to create something relatively fantastic. And so we've
invested in 2 companies that are just built on no code entirely. They're not no code tools. It's just they use no code tools. That's it.
It's a thing, guys. It's a thing. So we're getting close to the end. I want to be cognizant of your time, but I want to ask just a couple more questions. So you recently moved. So this is some radical transparency. So you recently moved to Mexico City. I'm just going to leave it there. Why? Why? Is it strategic? Or is that, tell us. Give us a little bit of a lowdown.
I'll tell you the why and the how. So the why is very straightforward. My wife works for the State Department, and so she took a job when I started Earnest. I was working from Rio de Janeiro, Brazil. Again, she was posted there to the consulate, and then she moved to her job to the embassy here in Mexico City. So I'm just kind of following around, and I tell everyone that
great to be a VC.
I tell folks that it's funny because actually being a diplomat seems like a really, really hard job. There's a lot of pretty tough work, but I have to tell everyone, being the spouse of one is amazing. There's all kinds of great perks. You get to go to cool cities like Rio and Mexico City. But the how is also interesting, which is that, essentially I've always, for the last 10 years, built every organization that I've worked in as remote first. And so Earnest, it's not necessarily our investment thesis that we are a remote fund, but we are by necessity and by strategy. So we have, our portfolio is entirely remote, which means that although we don't avoid San Francisco and New York, most of our investments happen to be in kind of much more, what you might consider, off the radar cities in terms of tech hubs. Most of the companies that we back are building remote companies. We ourselves are a remote community of both the portfolio companies, and then as well we have a group of about 40 mentors that are investors in the fund, super experienced SaaS founders, like the founders of Basecamp and Wildbit and Gumroad and all these sorts of things. They're also a part of the community, so we're all hanging out in Slack and Basecamp and Zoom, and everything is remote first, with the exception that we're bringing everybody to Mexico City for a big conference called the Founder Summit, actually in 2 weeks. But beyond that, we're just 100% remote first.
Is it portfolio investments only? Am I allowed to?
No. Is portfolio companies and mentors are going to be about a third to a quarter of the attendees, and then the rest we opened it up because we basically were bringing them anyway. So we said, well, this is pretty much the makings of a pretty awesome meetup for a bunch of remote kind of bootstrap focused founders, and so we're bringing everybody here for about 4 days to hang out, do a bunch of cool workshops, eat some tacos, and have fun.
I love it.
But I mean, it's cool because I'm going to meet about 2/3 of our portfolio founders for the first time in real life. Everything else we did, via Zoom and all that.
Well, maybe you and I can talk about it. Maybe I can find my way down there. It'd be I think it would be a lot of fun. But
come on down, man.
What I really appreciate about, again, you said it's not your thesis, but the remote first constraints I think are really powerful because it requires you to think and use the tooling of today and to be creative when tooling doesn't exist. And so, and since the world is moving that way, I'm saying this with a lot of bias, by the way, all of my startups have been, we have distinctly written into kind of the charter of our company. We are remote first. That's just how work has to get done. Because we got people in Atlanta, New York, San Francisco, over in Ukraine. So it's just the way the world works now. So I think it's the right model to use. I have one last question, and I think this is going to be helpful to everyone out there. On December, you probably know we do a lot of research here, so I dig. On December 23rd on Twitter, 2013, so we're going 7 years back here, guys. But this is good. I'm really excited for your answer. On Twitter, December 23rd, 2013, you said, automate bullshit in your life. Get back to doing things that matter. So what's your best recommendation? Being a man who's remote, moving all over, obviously automation is going to be a big thing for you. What would be your best tips for people out there on what to definitely automate?
Well, I mean, I don't know if you know, but you set me up for a total plug here for one of our portfolio companies. But
do it. That's fine.
you should check out MakerPad. MakerPad is one of our investment companies. It's started by Ben Tossel, who actually started here at Earnest, and then his side project started blowing up. And so we invested as he departed, which was great. It is the hub of the no code movement. So, I mean, it is just as many tutorials as you could possibly consume on how to use tools like Zapier and Webflow and MemberSpace and Typeform and all that sort of stuff to automate things in your life. And I use it all the time. So, one of the things that I have right now is, we did this meeting in my calendar, which means Zapier is going to pull that and put you into an Airtable, which is going to categorize you and mention that, we had a Zoom call today, and I can later go back and set a follow-up or something like that. But I've got like a million little robots in my life, always, doing stuff like that. But you should find them on MakerPad. Yeah.
Guys, I'm telling you, the Disney movies just project the future, man. We're all going to be living on little robots, and there are also going to be little things working for us in the future. It's definitely going to come. Tyler Tringas, thanks so much for this awesome conversation. It was a blessing to me, life-giving to me. I really love the model of what you're doing over at Earnest Capital, and I really, really wish for your best success. We're going to be following. We're out there. We're going to be following Tyler Tringas, and I look forward to speaking to him a little bit after this. Tyler, thanks so much for joining the show. We'll talk soon.
Awesome. Thanks so much for having me. This was great, and keep at it. Can't wait to listen to some more episodes.
True startup story time. Guys, as a founder, I'm often asked, what are my go-to tools and technology that I use as I begin a startup? Well, that's easy. One of them is Dropbox. Dropbox is the easiest way to ensure that all your files and documents are synced on all devices, whether it be mobile, your local desktop, or remote. We want to thank Dropbox for supporting vchunting.com, and make sure to get your 30-day trial free at dropbox.com/business. Man, what a fantastic interview. I know I always say that, but all the interviews I do are fantastic. I love meeting VCs, and I love especially meeting venture capitalists with completely all brand new models of how they do business. And I was learning here, guys. Look at all these notes. I always got lots of notes. But man, I was learning. I was a student during this conversation, and I loved every moment of it. Tyler Tringas is a great storyteller, and you can tell. I hope you also get an opportunity to check out the field notes of Tyler Tringas. You can find him at vchunting.com/Tyler Tringas, because he's a great writer, and we're going to put lots of blog links down there. But one of the things that I appreciated the most is this idea of radical transparency. As I had spoken a little bit about with him, I didn't want to take up too much time, but I'm a big fan of it. I believe that is the model in which you garner people to yourself. That is the model in which people can resonate and they can become part of a greater community and do amazing things. I love this model of community and leveraging community to help each other out and grow. As some of you guys know, longtime listeners, you guys know that that's what I'm all about. I'm all about having an idea and co-building that idea with the community, right? That's a big thing for me. And so listening to Tyler talk about this, I mean, was I enthralled? Absolutely. Was I grabbed and pulled at the heartstrings of what he's trying to do and what he is doing successfully with bootstrapped entrepreneurs who also could use a little bit of venture capital as well? I think it's a great model. I'm sure that it's going to improve over time, and I don't even know the efficacy of it now, but I'm sure it's working at some level. But I'm sure it's going to improve with more community feedback, more learning, more experience, working with different variables, different founder variables and needs and desires and wants, and the negotiation between the founders and the investors, and this shared earnings agreement structure, which I really, really don't fully understand, but I like the premise, and I'm going to be rereading it to make sure that I have a better and firm grasp on some of the nuances and idiosyncrasies of it. But I also want to give out another shout out to MakerPad. So check out MakerPad. I don't know if it's .com or .io. You're going to have to Google it, MakerPad. But check that out. It's a portfolio investment. of Tyler's. So you'll be supporting him as a VC and the founder as well by checking it out. I'm definitely going to check it out because you need to automate stuff in your life. What else did I want to talk about? Man, there were so many other questions that I had, but it's just, we ended up spending such good time just talking about or listening really to his story of going into clean tech, of maybe the timing, and then didn't end up going right, didn't end up working out. Coming from a financial background, going to clean tech, starting his own micro SaaS business with recurring revenue, getting to the point of acquisition, going and thinking about how he could serve the Bootstrap community, I think, which was an outcome of his blogging and his writing, and brought a community to himself and made something of it. I think this is a great example and great story for all of the founders, for all the entrepreneurs out there, for all the bootstrappers out there. This is a powerful story of that not only is it possible, but there are now mechanisms and funding and funds like Tyler's, Earnest Capital, that you can leverage and connect with if you might be in the position to need a little bit of venture capital to get you to the next level. And so this brings a lot of joy to my heart. It brings, because I know about most of the different type of investment vehicles and different mechanisms for investing in venture capital, but this one was new to me. And it really, as a bootstrapper myself, I just love the idea. And I will be honest, I will be modeling 100%. I'm going to be taking a couple of the lessons that Tyler Tringas has learned building his fund and using those for mine as well, because there's a pretty nice intersection between the community type of fund that I want to create and what Tyler's already built here. I love this conversation. I can't wait to listen to it again and go through the field notes and create those guys. Tyler's a great guy. Check him out. If you're a Bootstrap VC, check him out. You can find more information on this field notes and all the links and all the stuff to find him. And you can find it all on vchunting.com/Tyler Tringas. Guys, this was a great conversation. I can't wait to do more. Have a good one. We'll see you next time.